Our next guest has been dissenting in favor of bigger cuts at recent meetings. Fed Governor Stephen Miran joins us now for a CNBC exclusive. Welcome. Good to have you.
Good morning. Thanks for having me back.
Has your view changed at all as a result of the rising oil prices and diesel prices and fertilizer prices about the outlook for inflation?
Yeah, so traditionally the Federal Reserve looks through an oil price shock. Now, the reason why we do that is because oil price shocks tend to boost the price level immediately. They flow through into prices very quickly. Gas prices move higher. But monetary policy only hits the economy with lags. It doesn't, if you change monetary policy today, it doesn't affect economic growth. It doesn't affect unemployment or inflation for 12 to 18 months from now. Right? So if the oil price boosts the price level today through the gasoline price and other things, but not 12 to 18 months from now, monetary policy simply cannot affect that. Now, the way that wouldn't work, that this traditional logic the Federal Reserve has always observed, the way that this logic would not work is in one of two scenarios. One is you get a price-wage spiral, where wages start moving higher and then prices start moving higher too. There's not really any evidence of that thus far at all. And with the labor market on a gradual cooling trend for the last 3 years, that seems extremely unlikely. The other way that you would get the oil price shock boosting inflation 12 to 18 months out is if inflation expectations started to get affected. And when you look at the inflation expectations, you don't really see that. So I like to look at CPI swaps. CPI swaps for the next year moved higher because prices move higher immediately, exactly as we said. But when you look at forward rates, when you look at inflation expectations, 1 year forward, 1 year, 2 years forward, 1 year inflation, 3 years forward, they haven't budged. And when you look at medium to long-term inflation expectations, like 5 years forward, they've actually been coming down since this entire thing started. So in order to get an inflation shock from oil that the Federal Reserve can affect, it needs to affect inflation beyond a 1 year horizon, and there's thus far no evidence
all
of that.
That is true, but you know, there was evidence, first of all, that the Fed's inflation target was higher. I mean, that inflation was higher than the Fed's target going into this, right? And that what this will do is, even if it's in the short term, will have an impact on headline CPI, on PCE, you know, the longer this lasts. And it's now, we're 5 weeks in, and there are concerns that it will have a bigger impact on underlying inflation, even if you're not seeing it necessarily in those expectations or wages.
Yeah, so if I saw one of those two things happen, if I saw a wage price spiral or I saw evidence that inflation expectations were starting to pick up, then I would get worried about it. But as I said, there's no evidence of it thus far. And you can move the monetary policy rate all you want, you know, today, tomorrow, but it's not going to affect inflation the next couple of months, right? It can only affect inflation a year to a year and a half out. And unless you start to get evidence that inflation a year out is moving higher.
So is that just
monetary
something
policy
your colleagues don't agree with you on? Because most of the other Fed members and officials that have been speaking in the last few weeks have said, okay, we're good to hold and see what happens with inflation here as a result of oil.
My sense is that a lot of those people had that view before the Iran war broke out. I don't have a real sense that anyone is sort of really moving their position as a result of this, and maybe they'll tell you otherwise. I can only speak for myself. But what I just outlined is traditional Federal Reserve logic and way of treating
the market has completely moved as a result of this war. It's taken out all the price cuts and now started to, I mean, we're not fully there, but increase odds of a hike.
Absolutely. Look, we're in the middle of a war, right? And if there's ever a time when markets are going to be volatile, it's in the middle of a war. So in a time like this, I'm disinclined to sort of disinclined to read too much into that. But you know, markets will do what markets do.
Would you argue it's made your ability to persuade would-be fellow dissenters, made it tougher?
You know, I don't think that the Iran war has really done that. But, you know, look, I think that the labor market was on a gradual cooling trend for 3 years running into this. I don't think that there's anything that I've seen to convince me that that trend has changed, and I doubt that others will come away from what's happening in the Iran war and have a different view than that, right? If you think about it, higher oil prices, higher gas prices, they suck money out of expenditures that consumers would be making on other products, and so it leads to lower overall aggregate demand. And in a time when the labor market was running in the wrong direction from the Fed's mandate to begin with, that makes me a little bit more concerned about downsides to the labor market, and it is the type of thing that I think the Federal Reserve can accommodate.
So you're more concerned about weaker growth and higher unemployment than inflation, clearly. And it feels like that's a reverse of most of the other folks at the Fed. Fair?
Well, I mean, I can't speak for the others. I can only speak for myself. But what's happened?
That was Powell's message at the last meeting, really, is inflationary risks are rising, unemployment is kind of stable.
What's happened has made me more concerned about that. And as I said before, I just gave you what would make me more concerned about inflation. It's seeing inflation expectations pick up more than a year out. It's seeing wages pick up in a way that was feeding a wage price spiral and not driven by productivity gains. Right? Wage growth has been coming down even with high productivity growth. Right? That tells you that the Fed is holding back labor demand in a way that I'm not sure that I don't think is appropriate.
So how much easier should the Fed be at this point?
Well, I think that at the moment, I think that we could be about a point easier, gradually done over the course of a year.
So you'd like to see now 25 basis point cuts?
That's what I voted for
meetings.
the last two meetings, 25 basis point cuts.